Good morning, everyone. Hello, can we hear me? Hello, good morning. Can we hear me?
Good morning, sir. We can hear you.
Okay, good morning, everyone. Yes, we are welcome to another section of the class under taxation. I made mention when we concluded value-added tax. Yeah, good morning. Thank you. You are welcome. So when we concluded on value-added tax, I made mention that we'll be moving to another income tax. So I have also we'll be starting with company income tax today, which is governed by what? By the CETA Company Income Tax Act 2004 Cap C21 LFN, Law of Federation of Nigeria. So under this category of tax, as we know, we said we have various types of tax. We have direct and indirect tax. Under the direct tax, we have what is called some of the taxes that relate to what you performing the activity yourself before you generate those income. So which is what direct, like the personal income tax, the company income tax, the withholding tax, the capital gain tax, and so on and so forth. Then we also have what the indirect tax, which relate to what consumption, goods and services. Like the last topic we just did is an example of indirect tax. That is the value-added tax. So this company income tax is a form of what? Direct tax. That is what collected from company. It is collected from, as the name implies, company income tax. It is what? A tax that is payable by company. So only company pay this tax. And it is not, yeah. And it is not whether the company, so the word company means that what? So that company now can be defined as what? As an artificial person that has his own what? His own life that is separate from that of what? Any problem? So a company is an artificial person, is an entity on its own that is different from those people, from those individuals who decided to come up with that company. So they formed the company to be what? To be doing what? Certain business. And that company will be regarded as what? As a separate entity from those what? Entity who form the company. As far as company is concerned, we can have two categories of company. We have what is called what? Resident company and non-resident company. So a Nigeria company. A Nigeria company are those companies that are what? Incorporated in Nigeria with what? With the corporate, with the CAC, Corporate Allied Commission. So if a company is incorporated, so they are the one that will issue what? The CAC number. So that will be regarded as a Nigerian company. Why a non-Nigerian company are those companies that are not incorporated in Nigeria, but they generate income from Nigeria. So they are regarded as a non-Nigeria or non-resident company. So whether a resident company or a non-resident company, the profit of both companies are liable to tax in Nigeria. In the case of a Nigerian company, the profit of a Nigerian company is liable to tax on their global income. For a Nigerian company, their profit is liable to tax on the global income, whether the income is from Nigeria only or from outside. That means a Nigerian company will pay tax in Nigeria to both the income they generate, they derive or receive in Nigeria, and income they also earn from abroad. But any income they now earn from abroad, a relief will be what? Will be given to them, which is regarded as what? Double taxation relief to what? To cushion, because that place, that country, where that foreign income is being generated, they will have also what? Subject that income to tax. So any tax they pay there will be what? Will be given as a relief here in Nigeria. Then why a non-Nigeria company, a non-resident company, we only be liable to tax in Nigeria to the portion of only the income they receive or derived from Nigeria. So that means if a non-resident company does not derive any income from Nigeria, such company will not be liable to tax in Nigeria. And companies are liable to tax on what is called a preceding year basis. So they are going to, so that means what? All the income, all the profit they generated in the previous year, let's say the profit generated in 2023 will be what? Will be liable to tax in the year 2024, which is on what? On preceding year basis. So, and as I said, this tax is collected by only the Federal Inland Revenue Service. Only the federal government collect this category of tax, which is what? Administered by the Federal Inland Revenue Service. So I also made mention earlier that what is governed by what? By CITA, Company Income Tax Act, CAP C21, LFN 2004, as well as what? Other regulation of what? Of the Finance Act. Before now, companies are usually regarded as either small company or any other category of company. But the Finance Act, in the 2019 Finance Act, the 2019 Finance Act has brought what is called what? Categorization of company. So the 2019 Finance Act has now categorized company into three major forms. So companies are now categorized basically into three major forms. We have what? The first one is small company. We have what is called the medium company and the large company. So this categorization now, how do you now what? Know whether this company is a small company or is big company or a large company or a medium company? This categorization will be determined based on what? On their turnover. On the turnover of the company will help us to know whether what a company will be what? Will be categorized as either small, medium, or large. So a company with a turnover, small company and company with a turnover of 25 million and below, 25 million naira annual. If a company is having a turnover of 25 million naira, annual turnover of 25 million naira and below, so they will be regarded as a small company. And their tax rate is what? Is 0%. So the implication of that is that means small company are what? Exempted from payment of tax. Why medium company? Those are companies with turnover of above 25 million, when the turnover is more than 25 million. Anything above 25 million and less than 100 million naira per annum. So above 25 million naira and less than 100 million naira per annum turnover will be regarded as what? 20. So, and their medium company, and their own tax rate is 20%. Then one large company, those are what? Company with turnover of what? 100 million naira and above. 100 million naira and above, their turnover is what? 30%. Please, in the examination hall or in any question given to you, where the examiner did not give you, did not tell you, did not provide information in relation to what? To the turnover. Assume large company. So that means what? The rate to be adopted will be what? 30%. Please let us take note of that. Where the examiner did not give us information about what? About the turnover of the company. So we assume what? Large company and adopt what? 30% as the rate of tax. So after knowing the three categorization of company, let us look at this categorization one after the other. The first one, we have a small companies. Small company, according to section 23 of CITA. As I mentioned earlier, that their own tax rate is 0%. That means they will be exempted from payment of tax. So the fact that they are exempted from payment of tax, that does not mean that what? They are not expected to register. They must also what? Register with what? FIRS. They must register with FIRS and prepare what? Financial statement. They must register with FIRS, prepare financial statement, and file return as at when due. Failure to do this, we also what? Will be liable to what? Penalty and interest. So that means what? The fact that they are not going to pay tax does not what? Remove them from where? Other responsibility of what? Filing return, registering for tax purposes, and what? And other. So they must what? Register for tax, and also file return, and also prepare account that will show that what? They are a small company. So in this, for small company, the tax law gave the tax authority to what? Because their turnover is 25%. So they may not have the capacity to engage the services of an auditor, in which what auditor is going to collect what? An audit fee. So the tax authority, the law gave them a right to what? The tax authority can specify that, okay, they can prepare what is a financial statement that is lesser than what? Audited financial statement. The tax authority may accept what? Management account from them. And one of the things that is usually, when we talk about withholding tax, we made mention of an agent for withholding tax. Some of the agents are company. So small company now, because they are company, so that means what? They will also be agent of withholding tax. But the law has said that what? They are not going to be liable to tax. So the implication of that is that what? So that means small company can no longer what? They are no longer what? Liable to what? To withholding tax, as well as what? They can also not charge what? Withholding tax. So they cannot what? They cannot charge withholding tax, and they can also not what? Not deduct withholding tax. But in a situation whereby what? Whereby they have suffered any withholding tax. Because the fact that they are small company, that does not mean that what? They are only going to deal only with small company. They may have the opportunity to deal with what? Large company or medium company who are mandated to what? To deduct withholding tax. So that means if they deal with what? Large company, those ones are going to what? Withhold their what? Their taxes, their income. So any taxes withhold on their behalf will be what? Will be refunded to them by what? By the relevant tax authority. So it will be refunded to them by what? By FRS. Where they have suffered what? Any withholding tax. So where they have suffered any withholding tax, it will be refunded to the company. Also, part of the tax that is payable by companies is what is called tertiary education tax, which is either at the rate of 2%, 2.5%, or 3%, depending on what? On the year of assessment. We are still going to talk about that. So small companies also, because they are not liable to company income tax, they are also what? Not liable to what? To pay what? Tertiary education tax. So that means what? They are also what? Exempted from where? Payment of tertiary education tax. So they cannot what? They cannot pay tertiary education tax. Also, capital allowance. This small company, I explained this when we treated capital allowance, but let me just explain again. Small company, because they are also going to make use of what? Qualifying capital expenditure to what? To carry out their business. But they are not liable to tax. So that means those qualifying capital expenditure, and the law is that when you incur qualifying capital expenditure for the purpose of business, you are liable to what? You are expected to what? To claim what? Capital allowance. So that means any qualifying capital expenditure incurred by a small company will not be available for what? Capital allowance computation. Why? Because they are not going to what? Be liable to what? To tax payment. As a result of that, they are not going to what? Pay what? They are not going to claim capital allowance on those assets. So those assets, down the tax law, the tax authority does not expect them to be what? To be a small company throughout what? Throughout the entire life. So they expect them to what? To move from small to what? To either medium or large company. So any qualifying capital expenditure they buy during the period they are small will not be what? Available for capital allowance. But by the time when they now move to medium, so where the asset is yet to claim the capital allowance for those periods, so any balance of that asset will be available for capital allowance computation, in which they are going to claim what? only annual allowance. So when this law came up for small company, the categorization of company, the tax authority, they know that taxpayers are very smart. Some people may decide, because the tax law has exempted certain amount of income turnover from payment of tax, which is 25 million and below. Some taxpayer may decide to ensure that what they now float various companies in which they will be using that company to do the same business and ensure that what annually the turnover of what of those companies will not be more than what more than 25 million in order to what to avoid the payment of tax. Because government knows that people may want to do that, government now brought what is called Anti-Abuse Act. Anti-Abuse Act. This act is to cushion the effect of what? Of people what? Trying to what? To take advantage of what? Of the benefits provided to small company. That means what? If you are a small company, any attempt, as if for a company, any attempt for any company, for the shareholder of any company to vote, to float various companies, to be doing businesses in order to avoid payment of tax will not be what? Will not be regarded as small company. So what the tax law is going to do is that what? Such company will be what? All the activity of those companies will be what? Will be merged together, will be aggregated together and be regarded as what? As a single company that will be liable to tax. Again, the director of those companies will also be what? Will also be liable to what? Penalty and interest for what? And prosecution for what? For contravening what? The laws of the land. So what? In essence, what the tax law came up with is that what? You cannot use the what? Use the advantage of being a small company to what? To avoid payment of tax by floating what? Various companies. So if we are now saying company income tax, what are those persons that are liable to this company income tax? As we said, it's company. So a company will be liable to company income tax either in its own name, whether in their own name, the name that they know them with, or in the name of what? A principal officer, attorney, factor, agent, or representative in Nigeria, where the company is a non-resident company. It is their representative that is acting for them in Nigeria. So they will be liable to tax in the name of their representative in Nigeria. So where the company is also what? Engaged in what? In winding up liquidation process. The company will be liable to tax in the name of what? Of the what? Executor or the what? The representative what? Appointed by what? By the court. So what this means is that what? The implication of this is that income tax is payable on only the worldwide income of a Nigeria company. So a company incorporated in Nigeria, which I have explained earlier. So that means a company can be liable to tax either in its own name, in the name of what? Its agent, or where the company is engaged in what? In the process of winding up. They are going to appoint what? A liquidator or a what? A receiver. So that's what it can be what? They can also be liable to what? To tax in the name of what? The liquidator or the receiver. So those are the way the company can be liable to tax. Any questions so far? Any question? Any question?
No question, sir.
Okay, let us proceed further. So in order to calculate this company income tax, how do we what? How do we go about what? Calculation of what? Company income tax. So what are the bases? What are the way in which what we can calculate what company income tax? So the way in which company income tax can be calculated. So we have the four major ways of calculating company income tax. There are four ways of calculating company income tax. So one of them, you can use what is called a total profit basis. So it's either we use what is called total profit basis, which is usually the main basis of what? Calculating what? Company income tax. We can use what is called what? Minimum tax basis is also another basis. We also have what is called what? Turnover basis. And we have the last one, which is what? Dividend basis. at this level that we are, so basically,
You are
the
too fast.
examiner, I'm too fast. Hello?
Yeah.
Okay. Okay. All right. So at this level, examiner expect us to know basically the first two bases, those first two bases. So that is what the total profit basis and the minimum tax basis, to know basically more information about them. Why are the what? At the final stage. So you are expected to know what? To know information about all the bases. But you are expected to know that what? There are 4 bases that we can use what? In calculating what? Company income tax. So those 4 bases are what? Either we use what is called what? The total profit basis, the minimum tax basis, or we adopt what is called, so the minimum tax basis, or the turnover basis, or the last one, which is what? The dividend basis. So those are the what? 4 basic bases. So as I told us, at this level, we'll be concentrating basically on what? On the first 2 bases. So the first one, we are going to look at what? Total profit basis. So for the total profit basis, I'm going to share an Excel. That's what I'm going to use to illustrate what? That's what. So that information. Total profit. Can we see the Excel?
Yes, sir.
Yeah, so total profit basis. So how do we work? What do they mean by this total profit basis? The implication of this total profit basis means that what? Carrying out what? Adjustment of what? Of the profit provided by what? By the company, in order to arrive at what? At the total profit that will now be subject to tax. Carrying out what? Adjustment on the what? On the account provided by the company, by what? By the taxpayer, in order to what? To arrive at what? At the total profit that will be what? Subject to tax. And this adjustment, so because by the time the company is going to prepare the tax liability, by the time they are going to prepare their account, they are going to look at what? All their expenses. And it is not all expenses that are what? That are liable, that are allowable for tax purposes. Some expenses are what? Are disallowable, while some are what? Are allowable. But by the time the accountants, the company is going to prepare the account, they are going to what? Prepare it using what? Stating all the expenses. So total profit now what? Involve what? Looking at what? Those expenses that are what? Allowable, and those income that are what? That are subject to tax, because not all income are liable to tax under what? Under the company income tax. So how do we what? How do we look at it? So to calculate the total income as a total profit basis, as I said, you have to look at what? Adjustment. So the first thing in calculating total profit, you start with what? Name of the company. Let's say the name of this company is what? XYZ. Assuming you have a company known as XYZ. So let's say XYZ PSC. So you will now be asked, the examiner is going to ask you to compute what? Computation of tax liability. The total profit will help you to what? To determine tax liability for relevant year of assessment. I don't know the year. So in computing the tax liability, I'm going to state what? Certain information. So using this total profit, before I proceed further, okay, we have 2 bases. We also have 2 methods that can be adopted using this total profit, 2 methods. So we have the first one, we have one method which is called what? The net profit approach. You can either use the net profit approach, or we have the second one, which is called what? The turnover approach. It's either we use the net profit approach or the turnover approach under the one, the total profit basis. So the first one that we are looking at is the net profit approach. Net profit approach. How do I know that I need to adopt the net profit approach? So that means the information given to you, the account given to you, is going to give you information about the net profit. You are going to have what? Information about the net profit. So when you have information about the net profit, what that is telling you that what? You must adopt what? The net profit approach. Please, when you have information about the net profit, don't go and apply what? The turnover approach. Why? Because you may not have what? All the sufficient information to what? To use what? The turnover approach. Where the examiner expects you to apply the turnover approach, the examiner will not give you what? The amount of what? Of the net profit. So when you know the net profit, so to make the adjustment, you start what? With the net profit, you state the amount of the net profit. Net profit, you state net profit reported. You state how much is the net profit reported by the company. So you state that amount. So as I said, out of those expenses there are some that are what? That are not allowable. You now add them back. So you now add what? Disallowable. They call them disallowable expenses. So we are still going to explain them. So you add them back. Disallowable expenses. Then also, you also add as well taxable income. There are some taxable income omitted. What do we mean by this? There are some income that are supposed to be what? Liable to tax. But during the time they are preparing the net profit, that income has not been what? Has not been taken into consideration. So in order for you to what? To take that income into consideration, you have to add it back to what? To the net profit. So the addition of these two items will be what? Will be added to the net profit. After you have added that, you also goes further to say less. So you know less what is called what? Non-taxable income. There are some income that they call non-taxable income. Non-taxable income included. Non-taxable income included. So what do we mean by this? By the time they are preparing this net profit, there are some income that are not supposed to be what? To be part of. Some income are not supposed to be what? Part of what? Income that will be liable to what? To tax under company income tax. We are still going to look at them one after the other. So those income now, they have been added before they arrive at what? At the net profit. So we must what? Eliminate that income. You remove that income. You also less again. You also say less again. You also less allowable expenses omitted. Allowable expenses omitted. There are some expenses by the time you were preparing this net profit. Those expenses are supposed to be what? Part of the expenses that are supposed to be included as part of the net profit. But those expenses are not included. So because they are not included, so the next thing for you is to what? To add them. So to what? To also look at them and what? And less them from the net profit. So you add this two information, you will now less it from where? From this or two total information. So when you less this information, the resulting figure will give you what is called adjusted stroke accessible profit. Please, for company, adjusted profit is also the same thing as what? As accessible profit. So please, let us take note of that. So when you less that, so the resulting figure will give you what? Adjusted stroke what? Accessible profit. Which is what? Which is the same thing. So it can be adjusted, it can be what? Accessible profit. So for companies, because company they are expected to what? To relieve their loss. It is possible that this company before this year, there are some losses that they have incurred before this particular year. And when we did loss relief, we stated that what? Loss for company can be relieved till when? Who can remind us? For company, how does company relieve loss? Is there a limit for company to relieve loss?
No.
So losses can be relieved indefinitely. So there are what? So they have a right to what? To relieve their loss to till indefinitely. What about for individual? Is there a limit for individual to relieve loss?
Yes. I
How
think about
many?
3
How
or
many
5
periods?
years. 3 or 5. Yeah.
No. Any other person to assist us? Loss relief for individual. How many period? Is what? Maximum of 4 years. Maximum of 4 years. So it's maximum of 4 years for individual. But for company, they have what? They can relieve the loss till indefinitely. So that means what? If they have any loss that they are yet to relieve, so you bring that loss. You now say again, you say loss. So if there is any loss brought forward, you bring that loss. Out of this loss, so in jacket is a loss. Out of this loss, you look at what any, so you now say loss relieved. You look at how much can we relieve from that loss. So for loss, is there, so loss has no restriction for relief. So that means what we can relieve, once this total amount can cover this loss, you can relieve what the entire amount. So you remove it from this amount. So to get what? To get what the additional information after you have removed loss. So the next thing for you as a company is what? So when there is what? Disposal of what? Qualifying capital expenditure. That will give rise to 2 items. Who can remind us? When there is disposal of qualifying capital, when we did capital allowance, we made mention of this. When you sell qualifying capital expenditure, you have what? It will give rise to what? Two information, which are what?
Capital allowance.
No. Disposal of qualifying capital will give rise to 2 items, 2 amounts. Either what? Balancing charge or balancing allowance. And we made mention of this thing. It will give rise to what? Either balancing charge or balancing allowance. One of them is an income, while one is what? Additional allowance. Which one is an income? You guys are not reading
Balancing allowance.
No. Balancing charge is what? It's an additional income. That is when what? The sales proceed is more than what? The tax written down value. Balancing allowance is an additional allowance that will be what? Claimable. So if there is any balancing charge, you add because what? It's an income. Add balancing charge if there is any. So if they give you any balancing charge, add it. If any. So you add it to this information that we have here. So we add it to that information to arrive at that information. So after adding the balancing charge, so it's going to give us certain amounts. So it's going to give us a value. That value does not have a name. So after you have considered loss, you have considered balancing charge, the next thing for you is to look at what the capital allowance. So for the capital allowance, you may have capital allowance brought forward. So you look at how much they are bringing from previous year. You can also have capital allowance for the year. You may have a capital allowance for the year. So how much do we calculate as the capital allowance for the year? So the addition of these 2 items will give you what is called what? Total capital allowance. So this total capital allowance now is what you are going to relieve from this amount that you have here. You are going to relieve it from this amount. So capital allowance relief now will now be, please, there is capital allowance is usually restricted to what percentage? Who can remind us? Capital allowance is restricted to what percentage?
30%.
No. Capital allowance is restricted.
6 to 3rd or something.
Is restricted to what? 66 to 3rd of what? Accessible profit. Restricted to 66 to 3rd of accessible profit. So that, but if the company is into what? Manufacturing and agro-allied, there will not be any what? Any restriction of what? Of capital allowance. So it's going to be restricted to what? 66 to 3rd of accessible profit. So the implication of that is that what? If this company that you are preparing for is not a manufacturing or agro-allied, so that means the capital allowance you are going to relieve must not be more than 2/3 of accessible of accessible profit. It must not be more than 2/3 of accessible profit. So that amount that you now got as 2/3 of that accessible profit, that amount you arrive, which is the 2/3 of the accessible profit, is what you are now going to put here. Just calculate 2/3 of this amount. 2/3 of this amount of this accessible profit. Any amount you have here is what you are going to transfer here as well as the amount to be relieved. So where the amount you relieve is not up to this, so that means what you have what capital allowance carried forward. So that means you still have something to be taken to previous year. So any balance will be taken to previous year, which is the difference between this and this will be taken to previous year. So at this stage, this will be what? This item will be what? Will be closed at that level. So we have what? This item of what capital allowance will be what? Will be closed at the what? At the stage of what? Of this what capital allowance. Sorry, I'm coming. My system is acting now. We are now. Let's share. Okay. Let's come back. So at this stage, this capital allowance will now be what? So this one will be what? Will be closed at this stage. So the resulting figure you now have from this amount minus this will give you what is called what? That total profit that we said. Total profit, or instead of calling it total profit, you can also call it taxable profit. So it is this taxable profit now that you now, so which is the difference between this and this, will give you what? The taxable profit. So it is this taxable profit now that the company is now going to what? Is now going to pay tax on, which is what? This amount. So this taxable profit now is what they are now going to pay tax on. So you now close this, you now calculate what? Company income tax, CIT. So that to now get the rate will now be what? Based on what? At applicable rate. Based on what? Based on the level of the turnover, which can either be what? Either 20% or 30%. And I told you, where the examiner did not give you information about the turnover, what percentage are we going to adopt?
30%.
So 30%. So CIT will be what? At applicable rate, that will give you what? The company income tax. So after the company income tax, there is also a company that is what? That is also another tax that is payable by what? Company. So please, this tax is only payable by company that is registered in Nigeria. Please let us take note of that. Company that is registered in Nigeria, which are what? Either what? Medium or large. They call it what? Tertiary education tax, which is either what? 2%, 2.5, or 3%, depending on what? On the rate. So tertiary education tax at what? At applicable rate. So you also calculate that. So to be what? The tertiary education tax. Please, in the exam, where the examiner asks you, this tertiary education tax, if you are conversant with higher institution, you go to some higher institution, you see in part of their building, you see TED fund. That is where the money is coming from. There is a what? There is a body for a committee for it that is in charge of that money afterward. After FIRS have collected the money. So they send it to that committee who will decide where the money will be utilized for. So please, in the exam, where the examiner asks you for what? Total tax liability. Where the examiner says total tax liability, please add these two information. These two will now give you what? Total tax liabilities. Please, but where the examiner did not ask you for total tax liability, where the examiner just said tax liability, please don't add them together. Separate them. They are going to be a separate item. This one will be closed here, while this one will also be what? Will also be closed separately as what? As individual separate item. So please, that is how to what? To calculate what? Company income tax using what? Using what? Using total profit basis. So any question? Any question on that?
Sorry, sir. You were saying something about when the examiner said something. My network was breaking then. Please, can you repeat that part?
Okay, what I was saying is that when the examiner asks you for what? To calculate total tax liability. When he asks you for total tax liability, add these two together. Add these two and this one together and get the total amount. That will give you total tax liability. But when the examiner just say, compute the tax liability, please treat them as what individual item, the way it is being treated here. You can see that this one was closed here, while this one was also what closed here. Because what the examiner did not ask for total tax liability.
Okay. Thank you, sir.
Any other question? So after looking at the way of calculating what company income tax using total profit, so we now need to analyze what all this information one after the other. We need to analyze all this information one after the other. So the first one we are looking at is what are those expenses that were allowable expenses for company. So allowable expenses. So we are going. So one of the allowable expenses, we have what is called contribution to pension fund approved to joint tax board. Please, in the exam board. So they are going to tell you contribution to what? Approved pension scheme. That person should mute his or her mic, please. They are going to tell you contribution to what? Approved pension scheme. Because the pension scheme is not a contributory scheme now, whereby what the employer will contribute and the employee will also contribute. The employer will contribute 8%. The employee will contribute 8%, while the employer will contribute 10%. So which is what? So that 10% contributed by what? By the employer is an allowable expenses for what? For tax purposes. Then we have what? It is expected that when you are doing business, they don't expect you to make use of only your own money. You can decide to borrow money to run business. It is not a crime. So, and for borrowing that money, you are going to pay interest on that money that you borrow. Any interest you are paying on that loan for the purpose of that business will be what? Will be an allowable expenses. Any interest on loan obtained for the purpose of the trade or business will be what? Allowable expenses. Then we also have what? Bad debt written off. Provided the following conditions are met. Bad debt written off, provided the following conditions are met. One of them is that what? The debt must what? Must relate to what? To the normal cost of the business. Must relate to the business. Then that amount must also be what? Must has been included as part of the sales of what? Of that what year. That's what? You are writing off that debt. So then again, no deduction must have been made in respect of the debt before. Then for you to say that debt is bad, you must have carried out all what? All necessary steps by taking the taxpayer to the court, by carrying out litigation on that on that amount is owing you, in which the taxpayer has either been declared bankrupt or is unable to pay. So that's when you can now describe that debt as as debt which will be allowable, or what? The taxpayer must have undertaken all reasonable steps to recover the debt. So you must have taken over all those items to recover the debt. So when you are paying rent either for the business or for your employee is also an allowable expenses. Then we also have a provision for bad and doubtful debt. Under provision for bad and doubtful debt, we have two categories. We may have a specific and general. Please, the one that is allowable is where you see the word specific there. What that means is that means a particular amount has already been specified as that amount of the bad debt. It's not that means it's not a provision again. So that is specific. So when you see the word specific, it is allowable. So, but anyone apart from specific is disallowable. So when we get there, then we have legal expenses. Every company is expected to have an auditor, is expected to have a secretary, and is also expected to have a legal representative. So for having those three professionals, you are expected to be paying them.
The secretary, not the legal representative.
What did you say?
The secretary and the legal representative, what is the difference? Are they not the same?
Some company, they usually separate them. Some company will have a secretary, they may also have a legal representative separately. But in some company, the secretary will also be what? The lawyer, the legal representative will also be the secretary to the company, depending on what? On how the company decide their business. So because they are expected to what? To be part of your company according to the law, to Company and Allied Matter Act, it is expected that you must also be paying them certain amount as your what? As your representative. So that amount you pay them is what is called what? General legal advisory, or their what? The money to what? To retain them as their what? As your company lawyer, or as the company secretary, or as the accountant. So that money you are paying them as the company lawyer is what? Is an allowable expenses. It's either what? General legal advisory services or retainer's fee. Then we also have what is called lease. Under lease, we have two categories of lease. We have short-term lease and long-term lease. For these two categories of lease, you can either have acquisition or renewal. You can either have acquisition of short-term lease or renewal of short-term lease. You can also have acquisition of long-term lease or renewal of what? Long-term lease. Please, for lease, it is only renewal of short-term lease that is what? Allowable. Only renewal of short-term lease is allowable. Any other form of lease is what? Disallowable. Please let us what? Take note of that. Any cost of what? Protecting or defending the business. So you are protecting the business is what? Is also allowable. Rent and premium on any land occupied by what? By the business. So when you are paying rent for what? For the purpose of the business is also allowed. Cost of gifts to customer, incorporating element of what? Advertisement. You are making what? You are providing gift to what? To your customer, which is what? Branded. Those gifts must be what? Branded gifts. It must be branded in the company name. So it must be branded with the company name before it can be what? An allowable expenses. Then we have what is called rent. For any expenses to also be allowable, that expenses must be what? Must be rent. Must be rent for the purpose of the business, must be WREN for the purpose of the business. What do we mean by this? That expenses must be wholly, must be reasonably, it must be rent for the purpose of the business, must be wholly, must be reasonably, must be exclusively, and necessarily incurred for the purpose of the business. So for any expenses to be what? To be allowable, it must what? Satisfy this condition of rent. It must be wholly for the business, reasonably for the business, exclusively for the business, and necessarily incurred for the business. Where there is any element of what? Private in the expenses, it will what? It will not be what? Allowable for what? For tax purposes. So let us take note of that. Then another expenses that is also allowable for what? For companies or donation. As a company is allowed to make donation. So you can make donation, but it is not all donation that you make that are what? Allowable. That are what? Accredited bodies that what? Donation are what? Are expected to be what? To be made to. We have what? Bodies that what? Donation are what? Are expected to be what? To be made to. So those bodies are also what? They are listed. They are listed extensively as part of what? The material. So we have what? But there are some that are what? Very, very critical that you need to what? To have knowledge of. So we have a list of accredited body that donation is expected to be made to. So look at the list. We have the Institute of Medical Laboratory, National Library, Nigeria Bailey, Vanley, Peterson, and so there is one that relates to what? To our institute, which is what? The Institute of Chartered Accountants of Nigeria Building Fund. Please look at that word, that name, Building Fund. That name, Building Fund, must be there. You must be donating to what? Building Fund. Please. In the exam, where they just said donation to what? Institute of Chartered Accountants of Nigeria. Where that word building fund is not there, it's not going to be what? Allowable. It must be what? To ICANN building fund. Please let us take note of that. Then donation to Nigerian Institute of Management is also what? An allowable expenses. Then we have what? The list of all Nigerian Society for Deaf and Dumb, also allowable. Nigeria Boys Brigade, Boy Scouts, Girls Guide, National Youth of Nigeria, all are allowable. Then we have what? All the bodies that were donation are expected to be made to the Christian Council of Nigeria, Religious Foundation, MSSN, Kewara, Shenran Foundation Limited, Nigeria Museum, Nigeria Conservative Fund, all those, please let us what? Look at those bodies. That's what donation are expected to what? To be made to. Then for this donation to be allowed, there are certain conditions that must be what? Fulfilled by what? By the company before this donation can be allowed. One of them is that what? The donation must be made from where? From the profit of the company. You as a company, you cannot be what? Declaring a loss and claim that what you are making a donation. You must what? You must have declared a profit before that donation will be what? Will be allowed. Where the company is declaring a loss, the donation may be what? May be disallowed. So it must be made from profit made by the company. Then another condition is that what? Hello, you have a question?
Yeah, sorry to cut you short.
Okay.
So this expense is listed. From what I know, they are regarded as operating expenses, and they must have been deducted from the turnover before arriving at profit before tax.
Yeah, before arriving at profit, net profit, yes.
So this profit, are they still the ones that you are saying that will be deducted from the net profit that we are using to compute the total tax liability?
That's what. Look at when we did the format. Look at, let us go back to the format. Let us use this one. Look at it. I told you, allowable expenses omitted. The one you are going to deduct is the one that they have not what deducted. That word omitted is there. Allowable expenses omitted. That means that expense is supposed to be allowed, but by the time they are doing net profit, they did not what? Charge it. So that's the reason why you are removing it.
The word omitted before.
Yeah?
Yeah, I think my mistake is I missed the word omitted.
So that word omitted is there. Look at that format I gave you. If you look at who is that now? Please mute your mic. Mute your mic, please, please. So that word omitted is there. Omitted is there. So it has been omitted. That's the reason why you are what lessening it again. Where it was not omitted, you are not lessening anything.
Okay. I get you now. Thank you, sir.
So then so another condition, that's what that donation you will want to make must not be what? It must not exceed 10% of what? Company total profit for the year of assessment. It must not exceed 10% of what? Of the company total profit for the year of assessment. Please note that total profit we what? We said we use that format to get. The donation you want to make must not be what? More than that 10% of what? Of the total profit of that donation before removing that donation. Then another condition is that what? Where you are making donation to what? To universities, tertiary institution, or research institution. The percentage is more than 10%. That one, it must not be what? It must not exceed what? 15%. It must not exceed 15% of total profit. It must not exceed 15% of total profit, or it must not exceed 15% of total profit, or 25% of tax payable, whichever is higher, between 15% of total profit or 25% of tax payable, whichever is higher between the two. The donation, that's when you are making to what? Universities, other tertiary institution, or research institution. It must not exceed that 15% or 25% of tax payable. Which must not be what? It must not be more than that. So, or which one is higher? So then another condition is that the donation must not be capital in nature. You must not be saying when you want to make donation, you now want to donate house. It must not be capital in nature. So it must be what? It must be non-capital donation. So except the one that will be capital in nature is except when you are donating what? To universities, other tertiary institution or research institution. So that is the only when you can what? You can donate for what? For make donation that is what? Capital in nature.
What of those donation to Boy Scout and Boys Brigade?
That Boy Scout and Boys Brigade. So donation, it must not be what capital in nature. Boy Scout is not what a research institution or a tertiary institution. If you want to donate to them, it's either you give them a goose or you what? You give them what? You give them money. So they are now left to what? To decide what they are going to what? Use the money for. So you cannot say, okay, we have built a house for you. This is the house we want to donate to you. If you donate that, it will not be what? Allowable. It must not be capital in nature. Then, for it to also be what? Allowed, it must be what? Made to what? Approved fund. Those funds that are approved. It must be made to what? Approved fund. Approved fund. It must be made to approved fund. Which is what? As approved by what? So this fund, all these funds that we stated earlier, those are what they call approved funds. So for you to allow that donation, it must be what? Made to any of those approved funds. So where any of these conditions are met, so the donation will be what? Allowable for tax purposes. Then before we proceed further, after the donation, after those donations I mentioned about, there is also another form of donation. I don't know why it was omitted from this. So we also have what? COVID-19, pandemic donation. Pandemic donation, so let me explain that. Pandemic donation, or it can be what? Government established fund. So during pandemic, a lot of companies donated to that fund. So they made what? A lot of donation to that fund. So that donation they made now, because the tax law did not consider that in the previous, so the tax law has now what brought what a new reform. That's what when you make a donation to what government established fund, or when there is pandemic, unforeseen circumstances, a company now make donation. Such donation will also be what an allowable expenses. But there is also what there are conditions to that as well before the donation can be allowed. So a good example is what? COVID-19, when you donate to COVID-19. So this donation can be in two forms. It is usually in two ways. It can either be what? In kind. One of the donation can be you are donating in kind, or you are donating what? In cash. It can either be in kind or in cash. In kind in the sense that what? It may be that what the company decide that, okay, they want to donate their own products. Like what? During COVID-19, company producing what? Food items. They decided to what? To label those food items as what? As part of what? Relief. So they label it with what? COVID-19 logo and what? And distributed it to what? To members of the what? Public. So that is what? That is in kind. It can also be what? During COVID-19, some companies, instead of donating what? Items that are what? That are being labeled, they decided to what? To distribute what? Money in cash to what? To members of the public. That can be what? In cash. So the donation can be in two forms. So for this donation to be allowed, please, it must not be what? More than what? 10%. It will not be more than 10% of accessible, 10% of accessible profit. It must not be more than 10% of accessible profit. After allowing other allowable donation, after allowing other allowable donations, after allowing all other allowable donation. So that means for this one is what? Accessible profit. Why for all other category of donation is either what? Total profit, or is either 10% of what? Total profit, or if it is to university, which is what? 15% of what? Total profit, or 25% of what? tax payable. So for the pandemic, it is what? 10% of accessible profit after allowing other allowable donation. So that amount, so if they are donating either in cash or in kind, so they just provide evidence. So any amount they make must not be more than what? 10%. So where that amount is more than 10%, where the amount is more than 10%, any excess amount will be transferred, will be taken to previous years as allowable donation for a maximum period, of 2 years. So what that means is that unlike the first one that we talk about, those other ones, anyone that is disallowed, it has become disallowed. But for this one, anyone that is, because you are what? You are assisting members of the public. So where you have calculated the 10% of accessible profit, where the money you donate is more than that 10%, any balance is not going to be a waste. You are going to transfer it to next period as part of what? The donation for pandemic in that next period, that will also be subject for deduction. But it's only that amount is only available for what? For 2 subsequent years. After the 2 years, if you are unable to recover that amount, it will become what? It will be called lapse. So that is for what? That is for donation. So that is one other donation that is not what? In that material, which I need to explain. Please let us take note of that. Any question? Any question?
Yeah,
Any question? Yeah?
in the exam, you wrote taken to previous years instead of preceding years.
Yeah? What is
In the Excel, you wrote previous year, like all those excess amount after calculating 10% of the accessible.
Okay, I wrote what? What is that?
Year.
Period of 2 years.
No,
Taking to previous. Okay, future
yes.
year. I wanted to write taking to what? Well, future year. It will be taking to what? No, future year, not what? Not the previous year. Future. Yeah, 2 years for a maximum period of what? 2 years. Then after that, we have what? Disallowable expenses. What are those expenses at all? Once you see them, they are what? Disallowable for tax. So please, for the purpose of adjustment of profit, the first disallowable expenses that you can talk of is what? Depreciation. That is the first thing that should come to your mind. Why? Because company is going to claim what? Capital allowance. So they cannot claim capital allowance and also what? Benefits what? Depreciation. So it is the capital allowance that represents that was used to what? To represent what? The depreciation. So that means what? The depreciation will be what? Disallowable. Then any expenses that is capital in nature, any expenses that relate to a non-current asset, because they are going to claim capital allowance on it, it will not be allowable. Any private or personal expenses that does not relate to the business is also disallowed. Provisional expenses, any form of provision, except what? Except a specific provision for what? Bad and doubtful debt. Then we have a general provision for bad and doubtful debt. I told you, in the exam, you have 2 provisions for bad and doubtful debt. You can have specific and what? General. The one that is allowable is what? Specific. General is what? Disallowed. In the exam, where the examiner did not specify, where the examiner just say provision for bad and doubtful debt, assume what? General and what? And disallow that amount. Please, any sum recovered under an insurance or contract of indemnity, because of what? You are paying premium to get back that money. It's also not allowable. Any withdrawal of capital, any sum reserved out of profit, retain is not allowed. Any contribution to unapproved pension scheme. So when you are contributing to unapproved pension scheme, it is also not allowable. Fine and penalty, fine. It's not a tax, so it's not allowable. They did not ask you to go and commit offense. pre-operational or preliminary expenses. By the time a company is formed, there are some expenses that they are going to incur. Those expenses, they call it for pre-operational expenses. It is not an allowable expenses. Those expenses are usually capitalized, and they are going to be written. They are going to be written up for a certain number of years. So they call it what? Pre-operational or preliminary expenses. Loss on disposal of non-current assets. Then loss on disposal of investment. Legal expenses in the following regard. Cost of acquiring new lease. I told you earlier, we have two types of lease, whether short or long. Any cost of acquisition is what is allowable. Cost of renewing long-term lease, that is the only one. It is cost of renewing short-term lease that is what allowable. So cost you are going to use to renew your long-term lease will be disallowed. Cost of defending tax appeal. Government did not ask you to go and to not pay as at when due. Then stamp duty on increase in share capital is also disallowed. Cost of defending traffic offense is disallowed. Tax or penalty borne by a company on behalf of another person is also disallowed. Defalcation by what? Stealing by either the junior or what? Or senior staff. Covered by what? Contract of indemnity as provided by what? Section 22 of what? Of CETA. So as a company, it is expected that a company is expected to carry out what? An insurance policy of their transaction, of their item. So when there is defalcation, any stealing done by our staff is not what? It's not an allowable expense because it is expected that the company is going to collect what? Compensation from where? From the insurance company. We also have a gift and entertainment. For gift, please. Purchasing of the product of other company as gift to customer distributor will be disallowed. When you are purchasing what? Gift of another company, you are not distributing it to customers, it's a disallowable expenses. Let us take note of that. But when you are purchasing, when you are giving your own what? Products, branded, you now brand it as gift to customer, it is what? It is allowable. Branded gift to customer is allowable. So then when you also what? So gift to what? To staff, that is what? Allowable. So gift to staff is what? They are allowable. Gift given to staff or taxpayer shall be allowed. Gift to charitable are also exempted, although then we also have a gift to customer at reasonable, I will carry this conception. So like entertainment, also entertainment, when you are entertaining your what? All other expenditure entertainment and gifts are non-deductible. Gift to charitable, entertainment, when you are entertaining your what? Your customer, that is not what? That is just what? Entertainment of what? Of a small amount is what? Is allowable. But when the entertainment is outrageous, it will become what? Disallowable. Please mute your mic, Ijeoma. So it will become what? Disallowable. Then we have what? Loan written off. Any loan written off by company to staff and customer are disallowed. Please, because it is not what? It is not the nature of the business to what? To be giving out loan. So any loan they now give to their staff, they now write it off, or any loan they give to their customer and was written off is not going to be what? Allowable. So the only time loan can be allowable is what? Where that company is, where the loan written off is allowable is where the company is what? Is a financial institution. Where the company is a financial institution, that means what? Their main business is what? One of their major business is also what? Granting of loan. So as a result of that, so it will be what? Allowed. Then we have a loan to employee written off and non-deductible. Yeah, I said that earlier. Unless the business is that of making loan, or it can be shown that the written off of the loan was an emolument paid out for the benefit. Of the trade. Where that loan they are written off is what is an emolument of the business. As a result of that, it's going to be allowable for time. Then we have our traveling expenses. Traveling expenses. So when you are traveling, so like you are working out, so expenses expenses of traveling from home to here, from your house to the office. The travel expenses while you are on duty will be what? Allowable. Then so any form of advertisement that is not what? Capital in nature will be allowed. Like you're advertising on radio, on TV. But when it is capital in nature, it will be what? Disallowed. Because when it becomes capital in nature, that means what? That advertisement will be, is the implication of that is that when it is capital in nature, the advertisement will become what? Is going to, you are going to what? Capitalize that item. Example, foreign exchange losses. Please, under this foreign exchange, you can have gain and loss. You can have foreign exchange gain and foreign exchange loss. Under foreign exchange, we can have foreign exchange gain and foreign exchange loss. We can have foreign exchange. So we have foreign exchange gain and foreign exchange loss. So either foreign exchange gain or foreign exchange loss, any of these two items, you can have realized, you can have the one that is realized or unrealized. You can have the one that is realized for any of the two. You can have the one that is realized and the one that is unrealized. Please, any foreign exchange gain that is realized, because it has been realized by the company and it's a gain, it will be what? Taxable. Because it's a gain, that means it's an income. Any foreign exchange gain that is unrealized will be what? Non-taxable. So this is it. So let me analyze it. Foreign exchange gain realized, that will be taxable. Foreign exchange gain realized, taxable. Foreign exchange gain unrealized will be non-taxable, because that means it's just stated in the book. It's not an amount they have realized. So why foreign exchange losses realized, where it is losses realized, it will be allowable. So where it is foreign exchange losses unrealized, it will be what? Disallowable. It will be disallowable. So it will be a disallowable expenses. So please let us take note of that. So where the examiner is silent, the examiner just say foreign exchange, either gain or loss. Assume what? Unrealized. So please let us take note of that. Assume it is what? Unrealized. Where the examiner did not put either realized or unrealized in front. Assume it's unrealized. Then educational training. The educational training for staff and management is an allowable expenses if it is done to update what? Existing knowledge. Like what? You are an accountant now. You are the accountant of your company. Company is now paying for your ICANN. So they are paying to what? To improve your knowledge. So that will be what? Allowable. But you are an accountant. They now what? You now want to become a lawyer. You want to become a doctor. The company is now paying. So that means what? You want to acquire what? Another skill. In that case, that will be what? Disallowable. It will be what? A disallowable expenses. Then subscription to what? To any what? Any recognized trade organization, any recognized association is what? Is allowable. Subscription to ICANN. So when you are paying subscription of ICANN for your staff, it will be what? Allowable expenses. When you belong to a political party, subscription or donation to any political party will be what? Will be a disallowable expenses. So please, those are what? Those are expenses that are what disallowable for tax purposes. Any question?
Yes,
Any
sir.
question?
Yeah, it's an observation there.
Okay.
When it comes to entertainment, from my
Okay.
little experience, no matter how small, even if you entertain FIRS officials when they come for audit, they will still disallow entertainment. I don't know why it's like that. But
What
from
did
your
you say?
I said that entertainment, can you hear me?
Okay. Okay. Yes.
That from my little experience, that no matter how small, even if you entertain FIRS officials when they come for tax audit, they will still
Yeah.
disallow in your book. I don't know if I'm the
Yes.
only one experiencing that. So when
Yes.
it,
It should be disallowed. I told you that it is
yeah,
the onus of proving that that entertainment is what is reasonable. Lies with what? With the tax authority only.
so what can be reasonable entertainment?
The onus is given to the tax authority. Is tax authority, they are the one that can make the decision to either or decide allow or to disallow it. So the implication of that is that where you see entertainment in the exam, where you see entertainment in the exam, where the question did not tell you approve entertainment or it's not specific, the nature of the people that the entertainment is made to. So that means what it has to be what disallowed. But in practical sense, where the tax law gave what FIRS the authority to decide whether what the amount that will be what that should be allowed or to be decided. But in practical sense, they will look at it, the nature of the entertainment, and look at it that okay, who are those that you are entertaining? Because if part of the entertainment also belong to what entertaining tax official, so that means so they also need to what to look at what amount to be what certain amount that will be what allowed, because entertainment does not relate to only customer. If tax authority, if they also come for tax audit, the company also what engage in entertainment for them. Is that not so?
Yeah.
So that is also part of entertainment. If that is also included as part of your entertainment, that will be what part of what will be allowed. But the onus of allowable lies with them.
Okay. Thank you, sir.
Yeah. Yeah. Any other question? Then after that, we have what is called a taxable income. So what are those income? Any income that relate to a trade of the business is what is called what? Taxable income. So income from revenue or trade. This can receive. So you bought something from a supplier. It's not giving you discount. It's also what? An income. Balancing charge is an income. Bad debt recovered. So any reversal into income of a previously allowable expense, decrease in what? Specific provision for what? Doubtful debt. Then if you look at that format, taxable income, under that format, we have what? Let me go back to the format. We said here that taxable income omitted. That is what you are going to what? Add back. Where any of those income has been omitted, you add it back. So what are those things that may be omitted? As part of the omission, there may be what? Maybe the company, apart from their normal activity, they also have what? A property that they are collecting rent from. So the rent they are collecting from that property has been what? Omitted. Or they have what? Other sources of income that has not been what? Included as part of what? Their turnover. It will be what? It will be added. There may be what? Understatement of what? Their sales figure is also what? A likely omission. So those are what? Tax. Any income that relate to the business, that is what? Tax. So it will be what? Taxable. Then we have a non-taxable income. So those non-taxable income are income that are not supposed to be liable to tax. Under what? Under this particular scenario. Example is what? Dividend. Because dividend is what? What category of income is dividend? Who can remind us?
Frank investment income.
Yeah, frank investment income. We have stated that any tax you suffered on them is final. So as a result of that, it will be what? It will be regarded as what? As a non-taxable income. Then any profit on disposal of investment, any reversal on what? Income of a previously disallowable, decrease in what? General provision for bad and doubtful debt. Interest from where? Government bond or security. So when you invest in government bond or security, government shares or investment, so they are now paying you interest. It will be what? Disallowable expenses. Before now, any interest on what? Any form of bond is usually disallowed. But the time given forward for company has elapsed. Interest on what? On corporate bond is now what? Is now liable to tax. Illegal income is also what? Is also not what? Not what? Is also a non-taxable income. Any income as a result of bribe or any illegal income. Any tax-exempt income, income that is exempted from tax, that has been exempted from tax is also not liable to tax. Then we have some dividend exempted from tax, even though they are not going to charge what? Withholding tax on them. Example is dividend received in form of bonus shares, dividend received from Pioneer Company, dividend received from Unit Trust, dividend received net of withholding tax by a Nigeria company. So that means it will be a frank investment income. Dividend received from a small company in a manufacturing sector in the first 5 years. Dividend received from a foreign investment provider is received through a domiciliary account. Any foreign income received, any foreign investment income received is usually what? Not exempted from tax in Nigeria because what? So when you bring it through what? Appropriate channel, so it will be what? Exempted from tax. You also have some interest that are also what? Exempted from tax. Example is what? Interest that is received from abroad and brought into Nigeria through what? Appropriate channel is also what? Exempted from tax. We have some profits that are exempted from tax. Profit of a small company, as we stated earlier. Royalty that you receive from abroad and were brought into Nigeria through what? Through appropriate channel is also what? Exempted from tax. Profit of a Nigerian company in respect of a goods exported from Nigeria. When you are exporting from Nigeria, provided you are going to use what? The proceeds of that export to what? To purchase what? Raw material back into what? Into Nigeria. So when you are exporting now, any profit you made from that exportation, and you are using that profit to also bring back raw material into Nigeria, it will be what? It will not be liable to tax in Nigeria. So profit of what? Of any statutory or registered Frederick society that is not what? Not for profit making. So when the company is not for profit making organization, it will not what? So a profit of a statutory or registered friendly society, insofar as profit are not derived from a trade or business carried on by such or society. A not for profit making that is not doing business is what? Is not what? Liable to tax. The profit of any company formed for the purpose of promoting sporting activity where such profit are only expended for such purposes. Sporting activity and is not for profit making. So those are the profits expected from tax. So there is one particular, so the Finance Act, I think 2020 brought what is called a restriction on what? On deduction of interest. Initially, when we did allowable expenses, I made mention that it is expected that you don't use only your money to do business. You can decide to borrow to carry out the business activity. So when you borrow, any money you borrow will be what? It's going to be what? It's going to be any interest you pay on that money you borrow. It's going to be what? An allowable expenses. But where that money is, where that loan is between related party, know that information. That is, a parent company is borrowing its subsidiary money. When that loan is between related party, so there's going to be what? There's going to be restriction on what? On the amount that will be allowed. There's going to be restriction on the amount that will be allowed by the tax authority. So when the loan is between related party, so the amount to be allowed will be restricted to 30% of EBITDA. What do we mean by this EBITDA? It will be restricted to 30% of earning before interest, tax, depreciation, and amortization. So that means if that loan they borrow themselves is what? Between related party. So the total amount of interest that will be chargeable to tax will be what? Will be restricted to what? To 30% of EBITDA. Let us take note of that. It will be restricted to only 30% of earning before interest, tax, depreciation, and amortization. But it is not every company that is what liable, that is applicable to what, to this particular restriction. There are some companies that are what, that is exempted from this restriction. So a Nigerian subsidiary of a current company, a Nigerian subsidiary, look at it, a Nigerian subsidiary of a foreign company that is engaged in the business of banking and insurance business will be what? Will be exempted from this rule. So that is a Nigerian subsidiary. The company is here in Nigeria, but their parent company, their holding company is what? Is outside Nigeria. And what that company is doing is what? Is they are into what? Banking and what? Insurance business. This rule will not be applicable to them. Why? Because it is the nature of their business to what? To borrow themselves money. As a result of that, the rule will not be applicable to them. And after you have now considered the 30% of the EBITDA, any excess amount after the 30%, any excess amount after you have calculated the 30% will be what? Will not be a waste to the company. It will be taken to previous year. It will be available for relief. It will be carried forward to subsequent year for a maximum period of what? For not more than what? 5 years. 5 years afterwards, after the what? Assessment year. So it will be carried forward for a maximum period of what? 5 years afterwards, the year of assessment. Take note of that. Any excess amount will be carried forward to 5 years after the year of assessment. So failure to carry any company that is engaged in this and did not follow this rule is liable to penalty of 10% and what? And interest as well at interest as well at prevailing what? Monetary policy rates, which is what determined by what? By the Central Bank of Nigeria as applicable. So with this rule now, we are going to use an illustration to illustrate this one, interest deductible rule, because there was a question. So question has been tested on it before, so examiner can test question on it. This question relates to what? Page 11. This question relates to November 2021. November 2021. So we have the question that XYZ Limited was incorporated on August 31, 2012, and it commenced business on May 31, 2013. Dicky Malaysia is subsidiary in Malaysia, and Extracts. So that means they have a subsidiary in Malaysia. An extra financial statement of XYZ Limited for the year ended revealed the following: net profit, interest and depreciation deducted before arriving at accessible profit of 2 million as follows: interest on loan paid to Dicky Malaysia, other creditor, depreciation. With this now, that means what? It has shown you that there is what? Intercompany interest. There is an intercompany interest. So that means what? That rule must be what? Adopted. Which must be what? The amount to be allowed must not be more than 30% of EBITDA. So other creditor depreciation, based on the information provided by the company, it was discovered that out of the loan paid to other creditor, 450 was in respect of loan obtained to generate tax-exempt profit. The managing director of XYZ Limited approached you as the tax consultant to explain the provision of Section 24 of CETA as amended and sixth schedule in respect of interest deductible by a Nigeria company. Required: A, compute the interest deductible in the relevant assessment year. B, explain how the excess interest not deducted in the relevant assessment year will be treated. So you can see that is what, based on what? Interest deductible rule. So before I solve this question, I'm also going to explain another particular rule. I also want to explain one rule as well. So one rule which we also need to know, which is called what? Expenses incurred in deriving tax-exempt income. Expenses incurred in deriving tax-exempt income. What the law is saying is that any income that you are not going to pay tax on, Any income that is exempted from tax, any expenses that relate to that income will also not be what? Allowable for tax purpose. So what that means is that what? Any expenses that relate to what? Non-taxable income will also not what? Qualify as what? As an allowable expenses. I hope we got that. Any expenses that what? That relate to what? Non-taxable income will not what? Will not qualify for what? Will not qualify as what? Allowable expenses. It will not qualify as an allowable expenses. So that means if you are calculating, so you need to look at what? Those expenses critically to know which one is what? Relate to what? Taxable and non-taxable income. So in order to solve that question, so let us go back to the question. So looking at the question, we have what? We have the name of the company. So the first thing says, compute the interest deductible in the relevant assessment year. We know that tax is payable on what basis? Company income tax is payable on what basis? Preceding year basis. So that means this interest will also be available for deduction on what? Preceding year basis. So as a result of that, so I'm going to, so let us start. So we have what? We have the name of the company. So what is the name of the company? Yeah. So from the question, SYZ, Abby? SYZ Limited. SYZ Limited. So we are asked from the question to determine what? Compute the interest deductible in the relevant year. Computation of interest deductible in, so because I can know the year, so let us go to the question. We are giving this information for what? 2020. So that means the year of assessment will be what? 2020 what? 2021 year of assessment. So the first thing for us to look at what? We first of all need to what? To determine what? Determination. First of all need to get what? Our EBITDA. Determination of EBITDA. Which is what? Because if you look at the question, we are giving net profit. And net profit is what? Profit after what? All expenses has been what? Has been removed. Abi, is that also?
Okay.
So that means all expenses, like the depreciation, the interest, all the expenses will have been what? Removed. So in order to, and we want to get the profit before those expenses, EBITDA. So that means what? We must add back what? Those expenses. So we now start what? Determination of what? EBITDA. So we have what? Net profit. We have the net profit. We should write out the net profit. How much is the net profit? 2 million.
Yes,
Abi?
yeah.
So we add depreciation. How much is the depreciation given to us?
Interest and depreciation together.
Depreciation? No. If you look at the question, we are told that depreciation is what? 400,000. Depreciation 400,000.
Oh, yes, 400,000.
Then we have what? We have interest. I also need information about interest. Interest. Under the interest, we have two categories of interest. We have the one for Diki Malaysia. Diki Malay. How much is that one?
1,050,000.
1,050,000. Then we have the one for the other interest. We have the one for what? Other creditor. Abi?
Yes, sir.
How much is that one?
1 million.
1 million. Then I want to get EBITDA, which is what? Profit. Any before interest. I have added interest. Tax. So, and we are giving net profit. And net profit is what? Profit before what? Before tax. I mean, so that means tax cannot come in. Tax has not been considered. Before tax, depreciation, we have added the depreciation and what? Amortization. We are not giving amortization what? In this question. So the total information we are going to use will now be what? Total of this. So we are going to add all this to get this value here, the value here. So we add all this, we sum that up. So when you sum that up, it's going to give us the summation of these three will give us 2,450,000. So you now add it. So this will give us what? EBITDA. Abi?
Yes,
So the EBITDA will now be the addition of hello. I think the network went off, Abi. Hello?
Yes,
Yes.
So, okay. Where did we get it to before the network went off?
the EBITDA.
EBITDA. Yeah, okay, EBITDA. So this is the EBITDA. Then we need to get how much is the total interest in the year. How do we get the total interest in the year, in that particular year?
We cannot see it.
Okay, you can't see my screen. Okay, let me share it. Okay. Sorry. So we need to get how much is the total interest in the year. So how do we get the total interest in the year? You look at the addition of all the interest. So we have what? Interest. We have the one for what? Diki Malaysia. How much is that one? 1,050,000. Then we have what? Another interest. Other what? Other creditors. How much is that? 1 million. Abi?
Yes, sir.
So when you add up these two interests, it will give us what? 2 million and what?
50,000.
2,050,000. Total. This is the total interest. But the question told us something. In the question, when you go to the, let us go to the question. When you go to the question, we are told in the question that when we look at the question, we are told that based on information provided, it was discovered that out of the loan paid to other creditors, 450 was in respect of what? Loan obtained to generate what? Tax-exempt profits. And I already told you that so any income that relates to tax-exempt, any expenses that relate to tax-exempt income, what do? It will be what? Disallowed. Abi?
Yes, sir.
So we now say less tax-exempt expenses. How much is that? 450,000. Abi?
Yes, sir.
450,000. So the resulting figure now will now give us what? Total interest qualifying for deduction. So which will be equals to this 2,050,000 minus 450. So that will give us what? 1.6. So that means the interest we are supposed to deduct in that year in total is supposed to be what? 1.6 million. So because of that, you now calculate what? You now restrict it to what? 30%. 30% of multiplied by how much is our EBITDA? 4 million. This is our EBITDA, 4,450,000. So 30% of 4,450,000. That will give us, how much will that give us? 30% of 4,450,000. Somebody should work it out. Okay, let me do it. Equals to this multiplied by 30%. 1 million what?
335,000.
335,000. So that means instead of in that year now, in the year of assessment of 2021, instead of the company to charge what? To charge this amount of what? 1.6 million. They are only going to charge how much? 1,335,000. So total interest to be charged will now be equals to what? 1,335,000. So because of what? Because of the restriction. So because of the restriction, so interest to be charged will be what? Will be 1,335,000. So we can see that from where? From the solution. Look at it. So that's what I just did is what we have here, which is what? Interest deductible will now be what? Restricted to 1,335,000. So excess amount will now be the amount you are supposed to charge is what? 1.6. So the excess will now be 1.6 minus what? 1,335, which will give us what? 265,000. This excess is not a waste. B now asks us, explain how the excess interest not deducted in the relevant assessment here will be treated. So who can remind us, what do we say will happen to the excess amounts?
We take it forward for 2 years.
Yeah, it will be taken forward for a period of what? 5 years. Taken forward for a period of 5 years. After what? After the year of assessment in which the loss occur on a what? On a first in, first out basis. 5 assessment year. After the year in which it occur on a first in, first out basis. So that means the procedure will now be the treatment of excess interest not deducted in relevant year. The excess interest of 1.6 less this 265 will be carried forward and added to what? Interest expense for the year with a view to computing its restriction. It should be noted that the excess interest of 265 may be carried forward for a period not exceeding 5 years. That is, so 5 years afterwards, 2021 will be what? 2022, 2023, 2024, 2025, and what? 2026. So that means that amount is going to lapse as at our 2026 year of assessment on a FIFO basis. So while applying each of the year, the same rule based on which the excess interest was first computed. So that means every year, you also need to consider what? That's what 30% of EBITDA every year throughout the 5 years period. So that is what they mean by the excess interest. So that is an examination question. So it came out we can find it in our Pathfinder, November 2021 came out. That was the first time a question on interest deductible will be tested, and since then it's yet to be tested. So please let us look at it and familiarize ourselves with it. So any question?
Yes, I have a question.
Okay.
Okay, so when talking about profit exempt from tax, for example, the one I'm conversant with is dividend, for example.
Okay.
So this income will deduct it from the net profit.
Yes.
So now you're saying that all the expenses incurred to arrive at that profit exempt will still be deducted.
Yes, that's what the tax law says. Because you are not going to pay tax on that income, that expenses will also not qualify for deduction.
Okay, so we exempt the income and expense the expenses incurred in the process.
Yes.
Okay. Thank you, sir.
Yeah. Any other question? Any other question? Any question? Question? So please, in the absence of no question, we are going to stop at this level today. We're going to stop at that page 11, the question on that interest deductible. So, yeah?
I have a question.
Okay.
So, the EBITDA, I
Okay.
don't really understand the
EBITDA is
concept here.
simply any before interest, tax, depreciation, and amortization. That is, you want to look at the profits they are going to arrive at before they remove their depreciation, interest, amortization, and tax. That profit is what they mean by EBITDA. Any before interest. And you know that your net profit is the net profit they are going to give you, which is the profit the company is going to use to prepare their accounts. So that's what they are going to give you. So you need to adjust it back by adding backwards all those information. If they give you a profit after tax, please, that means you are also going to add backward tax. to that information. So that's what the EBITDA means. So any other question? Oh yeah, somebody should answer me. Any other question?